Something broke in the global financial system this week. Something fundamental. And if you don't understand what just happened between Wednesday morning and right now, Saturday, January 31st, 2026, you're about to lose money. Potentially a lot of it. Because what we just witnessed wasn't a normal market correction. It wasn't profit taking. It wasn't even a crash in the traditional sense. It was a signal, a warning. The first visible crack in a pattern that's repeated itself across every major empire in recorded history. And once this pattern starts, it never stops. It only accelerates. Let me give you the numbers first. Then I'll show you why they matter more than anything you'll hear on financial television this week. Microsoft lost $357 billion in market value on Thursday. In one day. That's the size of Netflix's entire market cap. Gone. But that wasn't the story. Gold hit $5,608 per ounce on Wednesday. Highest in human history. Then it crashed 12% in 18 hours. Silver plunged double digits. Lost decades of gains in under an hour. The dollar fell 3% against major currencies in 2 days. For a reserve currency, that's not a blip. That's an earthquake. And here's what nobody's connecting. On January 28th, the Federal Reserve paused all rate cuts, cited persistent inflation, political pressure from the Trump administration to cut rates anyway. Then, 24 hours later, European financial institutions started publicly questioning whether they should hold U.S. treasuries. Not quietly, publicly. China reduced treasury holdings by $120 billion in January, largest single-month decline ever recorded. Now, here's the part that should terrify you. The national debt of the United States reached $38.43 trillion on January 7th. That's $2.25 trillion higher than 1 year ago, which means we're borrowing $8 billion per day, every single day, including today. Interest on that debt hit $1.2 trillion in fiscal year 2025. We now pay more in interest than we spend on Medicare, more than we spend on national defense. Let that sink in for a moment. We're borrowing money to pay the interest on the money we already borrowed. And the pattern? The pattern says this is stage 3, the crisis phase, the moment when the math catches up with the delusion. And every time this has happened before, without exception, stage 4 follows, the collapse, the reset, the transfer of wealth from those who don't see it coming to those who do. So let me show you something, because this isn't theory, this isn't speculation, this is historical record, documented, verifiable. And once you see it, you'll understand exactly why the last 48 hours matter more than the last 48 months. There's a sequence, a pattern. 4 stages that every dominant empire moves through when they control the global reserve currency. Stage 1 is trust. Real trust, earned through actual productivity, military dominance, and sound money. The currency works because it represents genuine value. Everyone wants it. Everyone needs it. Trade flows through it. The stage can last centuries. Stage 2 is where the seduction begins. The empire realizes something dangerous. They control the money everyone uses. So they start creating more of it, not to produce more value, just to fund things they can't afford. Wars, social programs, political promises. The gap between what they collect in taxes and what they spend becomes permanent. So they fill it with currency creation, debasement, inflation. And here's the trick. Because they control the reserve currency, they export the consequences. Other nations absorb the excess money supply. The inflation gets delayed, pushed into the future. Stage 2 feels like prosperity, feels like winning. It's actually the beginning of the end. Stage 3 is the awakening. The math becomes impossible to ignore. The debt can't be paid, not difficult to pay, mathematically impossible. The currency starts losing purchasing power despite interventions. Foreign nations start questioning whether they want to hold reserves in a currency being systematically destroyed. Confidence cracks, not all at once. In waves, a bank here, a central bank statement there, then suddenly, violently, usually triggered by something that seems unrelated. A sovereign debt announcement, a geopolitical event, a market shock that reveals the fragility underneath. Stage 4 is the reset. The system breaks. The currency either hyperinflates or gets replaced entirely. Reserve status shifts to a new power or new system. Wealth transfers from those holding old denominator assets to those positioned in the new reality. This stage is brutal, fast, irreversible. Now, let me show you this pattern in action 3 times, 3 empires, same sequence, same outcome. Then we'll apply it to what just happened this week, and you'll see exactly where we are. Ancient Rome, 2nd century AD. The denarius was the dollar of the ancient world. Every trade route, every merchant, every transaction of consequence denominated in Roman silver. The coin contained 95 to 98% pure silver under Augustus, 4 grams of actual precious metal. Trust was absolute because the value was real. For 2 centuries, the system worked. Rome expanded, trade flourished. The denarius held its value because the metal content was genuine. That's stage 1. Real money, real trust, real value. Then came the expenses, massive military spending on expanding borders, Germanic tribes on the Rhine, Persians in the east. The army grew. Soldiers demanded higher pay. Emperors needed funds immediately. Tax revenue wasn't keeping up. So they made a choice. They started debasing the denarius. Nero was first. 64 AD reduced silver content to 90%. Still high. Still trusted. But the precedent was set. The door was opened. By Trajan, it dropped to 85%. Marcus Aurelius took it to 75%. Caracalla cut it to 50% and introduced the Antoninianus, supposedly worth 2 denarii but containing only 1.5 denarii worth of silver. The government was creating money by destroying its value. And for decades it worked. The empire kept functioning. Soldiers got paid. Citizens got bread and circuses. Stage 2 looked like strength. Then the crisis of the 3rd century arrived. 235 to 284 AD. 50 years of collapse. The silver content plummeted. By the reign of Claudius II in 269, the Antoninianus contained 2% silver. 2%. From 98% to 2% in 200 years. Prices exploded. A measure of wheat that cost 1 denarius in the year 200 cost over 200 denarii by 270. Foreign territories stopped accepting Roman currency. Trade networks broke down. The military couldn't be reliably paid. Civil wars erupted as generals fought for control. 26 emperors in 50 years, most assassinated. The system was dying in real time. That's stage 3, the crisis. The awakening to mathematical reality. Stage 4 came slowly, then suddenly. The denarius disappeared from circulation. People hoarded older coins with higher silver content. Bad money drove out good money. Diocletian tried reforms, price controls, new coins. Nothing worked. By the 4th century, the Western Roman Empire abandoned the denarius entirely, moved to taxation in kind, goods instead of coins. The economy became feudal, localized. The currency that had unified an empire for 400 years was gone. Wealth held in denarii evaporated. Wealth held in land, in productive estates and tangible assets survived. The pattern completed. Let's verify it with a second example. Different time, different continent, same pattern. Weimar Germany, 1920. After World War I, Germany faced catastrophic reparations. 132 billion gold marks, roughly 470 billion in today's dollars. The government couldn't pay through taxation. Politically suicidal, economically impossible. So they chose a different path. They printed. The Reichsbank's printing presses ran continuously. They financed reparations through currency creation. They called it necessary, temporary, a bridge to economic recovery. Classic stage 2 thinking. The numbers tell the story. In 1921, the exchange rate was 60 German marks to 1 US dollar. By January 1922, it was 191 marks to the dollar. Concerning, but manageable. Then stage 3 arrived with violence. July 1922, 493 marks to the dollar. November 1922, 7,000 marks to the dollar. August 1923, 1 million marks to the dollar. November 1923, 4.2 trillion marks to the dollar. 4.2 trillion. In 18 months, the currency became worthless. Here's what that looked like on the ground. Workers demanded to be paid twice per day because money lost half its value by afternoon. People carried wheelbarrows of cash to buy bread. A lifetime of savings couldn't purchase a week's groceries. The middle class was annihilated. Pensions evaporated. Bonds became worthless. Anyone holding paper wealth was destroyed. But here's what's critical. Wealth didn't disappear. It transferred. Those who owned land saw property values skyrocket in nominal terms. Those who owned foreign currency multiplied their purchasing power. Those who owned businesses and tangible goods survived and prospered. The pattern repeated. Currency collapsed. Real assets preserved wealth. That's stage 4. And then came the consequences nobody talks about. The social collapse. The political extremism. The economic devastation created the conditions for what came next. The Nazis gained power partly because they promised economic stability after hyperinflation destroyed the social fabric. The pattern doesn't just destroy wealth, it destabilizes civilization. One more example. To prove this isn't ancient history or a German anomaly, this happened to the world's superpower within living memory, the British Empire, 1815 to 1971. For over a century, the British pound sterling was the global reserve currency, the currency of empire. The sun never set on British territories. Sterling was backed by gold. Faith in the pound was faith in the empire itself. That's stage 1, global dominance, reserve status. Trusted money. Then came 2 world wars, massive military spending defending global interests, expanding social welfare, the National Health Service, pensions, housing programs. Government spending exploded while the industrial base declined. Former colonies gained independence, reducing tribute and trade advantages, but they kept spending, kept guaranteeing, kept expanding the money supply. They were Britain, the empire. They could afford it. Classic Stage 2. Stage 3 crystallized in September 1949. Britain was forced to devalue the pound by 30% overnight. Not a choice. A crisis. The market stopped believing. Foreign holders dumped sterling. By 1967, another devaluation. 14%. The pound, that had been worth $4.86 in 1939, was worth $2.40 by 1967. Purchasing power evaporating. Reserve status eroding. That's the crisis phase. Stage 4 arrived quietly but completely. 1971. President Nixon closed the gold window. The Bretton Woods system collapsed. The dollar replaced sterling as the undisputed global reserve. Britain tried to maintain status through the sterling area, a group of countries using the pound. It failed. By the 1970s, Britain faced stagflation. Inflation above 20%. Unemployment rising. Industrial collapse. The IMF had to bail them out in 1976. An empire reduced to charity case. Wealth held in sterling lost 70 to 80% of its purchasing power over 3 decades. Wealth moved to dollars, to gold, to American equities. The pattern completed again. 3 examples. 3 empires. Same 4 stages. Same outcome. Rome, Weimar, Britain. Setup. Expansion. Crisis. Collapse. Every time. Now let's talk about what happened this week. About the United States. About the dollar. About where we are in this sequence, because every single characteristic of Stage 3 is present right now, today. The United States established reserve currency status at Bretton Woods in 1944. We had half the world's gold, half the world's manufacturing, absolute military dominance. The dollar was backed by gold until 1971. But even after Nixon closed the gold window, trust remained. Oil traded in dollars. Central banks held dollars. International debt denominated in dollars. Stage 1 lasted decades. Real dominance. Earned status. Stage 2 accelerated after 1971. Once the gold backing disappeared, the temptation became irresistible. Federal debt in 1971 was $370 billion. Manageable. Reasonable. Today it's $38.43 trillion, a 100-fold increase in 54 years. Let me put that in perspective. We've added more debt in the last 15 years than in the previous 224 years of American history combined. Military spending exploded. We maintain over 750 military bases in 80 countries, cost hundreds of billions annually. Social Security was expanded beyond demographic sustainability. Medicare made promises no tax base could fund. The gap between revenue and spending became structural, permanent, unbridgeable through taxation. So the Federal Reserve did exactly what the Reichsbank did, what Rome did. They created money, quantitative easing, zero interest rates, emergency lending facilities, direct market purchases, creating trillions out of thin air, and it worked for decades. Because we controlled the reserve currency, other nations absorbed our inflation, bought our debt, enabled our spending. The consequences got exported, delayed. Stage 2 felt like American exceptionalism. It was actually American currency debasement. But something changed, something fundamental. And it became visible this week. Let me walk you through January 28th to January 31st, 2026, day by day, so you can see Stage 3 crystallizing in real time. Wednesday, January 28th, the Federal Reserve holds its first policy meeting of the year. Markets expect rate cuts. The Fed has been signaling easing, inflation supposedly under control. Instead, they pause. No cuts. Cite persistent inflation. Stubborn labor market. And here's where it gets interesting. The Trump administration publicly pressures the Fed for rate cuts. Launches investigation into Fed Chair Jerome Powell. Questions Fed independence. Markets initially shrug this off. Business as usual political theater. But by close, yields spike. 10-year treasuries jump to 4.3%. 30-year yields hit highest level since September. Something shifts, barely perceptible, but real. Thursday, January 29th. This is when the crack becomes visible. Markets open in Asia, down 6 to 9% across the board. Tokyo, Hong Kong, Singapore. All deep red. Because Asian markets understand something. If the Fed is losing independence, if political pressure is mounting, if inflation isn't actually controlled, then every dollar-denominated asset is at risk. European markets follow. Major financial institution announces it's unwinding $35 billion in U.S. Treasury positions. Not because of default risk, because of confidence risk. They explicitly cite unsustainable debt trajectory and political dysfunction. This is unprecedented. A major European bank publicly questioning U.S. fiscal sustainability. Markets don't shrug this off. They panic. By the time U.S. markets open, futures are limit down. Circuit breakers trigger in pre-market trading. When the bell rings, it's bloodshed. Microsoft announces cloud growth concerns. Stock drops 10%, $357 billion in market cap gone. But that's just the headline. The real story is gold. The metal hits $5,608 per ounce, highest price in human history, up 30% for the month. This isn't speculation. This is flight to safety. Flight from currency to hard assets. Flight from faith to physics. Then the margin calls start. The CME group raises margin requirements on precious metals. Leveraged traders can't meet requirements. Forced liquidation begins. Silver plunges double digits in under an hour. Gold crashes 12% from its peak. But here's what's critical. This wasn't fundamentals changing. This was leverage unwinding. The underlying driver, the loss of confidence in currency, that didn't change. It intensified. Friday, January 30th. The liquidation spreads. Crypto markets dump. Bitcoin falls below 88,000. Ethereum under 3,000. Why? Because leveraged traders are selling everything liquid to cover margin calls in precious metals. This is how contagion works. One market shock cascades into others. The correlation goes to 1. Everything falls together because the underlying issue isn't individual assets. It's the denominator. It's faith in the currency system itself. The dollar falls 3% in 48 hours. 3%? That's not normal volatility for a reserve currency. That's loss of confidence. Major currency traders start positioning for dollar weakness. Not tomorrow. Now. Today. Saturday, January 31st. Markets are closed, but the damage is done. The signal is sent. Let me show you why this fits stage 3 perfectly. Every single characteristic is present. Characteristic 1, sudden loss of confidence in sovereign debt. Check. European institution publicly questions U.S. Treasury holdings. China dumps $120 billion in 1 month. Japan considering reducing exposure. First major crack. Characteristic 2, currency instability despite intervention. The Fed issued emergency statements Wednesday and Thursday, promised stability, promised liquidity. The dollar still fell 3%. That's intervention failure. That's loss of control. Characteristic 3, foreign holders reducing reserve positions. Check. China's holdings reduction is the largest single-month drop on record. Japan's parliament is debating reserve diversification. Saudi Arabia is negotiating oil sales in yuan. The reserve status is eroding in real time. Characteristic 4, asset prices disconnecting from fundamentals. Check. Microsoft's business didn't change. Amazon's operations didn't collapse. Apple didn't lose technological advantage. But they all crashed double digits. Because this isn't about company value. It's about currency confidence. Characteristic 5, political paralysis preventing solution. Congress is deadlocked on debt ceiling negotiations. Again, the White House and congressional leadership can't agree on basic fiscal framework. The political system is incapable of addressing structural problems. The debt keeps growing. The spending continues. The borrowing accelerates. Characteristic 6, mainstream narrative of temporary disruption. Check. Every financial news network called this a correction, a healthy pullback, a buying opportunity. Exactly what they said in 1929. Exactly what they said in 2008. The denial is part of the pattern. But here's what's different this time. Here's why the transition to stage 4 could happen faster than any historical precedent. Institutional credibility is gone. In 1929, people still trusted institutions to fix it. Roosevelt, the New Deal. Faith remained. In 2008, people believed Bernanke and Paulson would stabilize the system. The institutions still had credibility. That's not true anymore. Public trust in the Federal Reserve is at multi-decade lows. Congress approval is single digits. Faith in the dollar as a stable store of value is openly questioned, not just by foreign governments, by American citizens. 23% of Americans now own cryptocurrency, specifically as a hedge against dollar debasement. That was 2% 10 years ago. The institutional credibility that allowed previous stage 3 moments to be papered over doesn't exist anymore, which means stage 4 could arrive faster, more violently, with less warning than any historical example. So let's talk about what stage 4 actually means. Because this is where people get confused. Stage 4 doesn't mean apocalypse. It doesn't mean society collapses into Mad Max chaos. It means the financial system resets. The currency either hyperinflates or gets replaced. Reserve status shifts, and wealth transfers. Massively, permanently. In Rome, wealth held in debased denarii disappeared. But wealth held in land survived. Productive estates, real assets. In Weimar, cash holders were annihilated. But real estate owners prospered. Business owners survived. Foreign currency holders multiplied wealth. In Britain, sterling holders lost purchasing power for 50 years. But those who moved to dollars, to American equities, to hard assets, built generational wealth. The pattern is consistent. Wealth doesn't disappear in transitions. It moves. From those who don't understand the pattern to those who do, from those holding old denominator assets to those positioned in the new reality. And here's what that means right now. If we're in stage 3 and stage 4 is coming, your financial positioning matters more than any decision you'll make in the next 5 years. But first, let's destroy the 3 most common objections. The 3 reasons people always think this time is different, because until you let go of these mental models, you can't position correctly. Objection 1, this time is different because we have technology, artificial intelligence, quantum computing, innovation that Rome and Weimar never had. Technology will drive growth that outpaces the debt. We'll grow our way out of this. Here's the problem. Technology doesn't change mathematics. Germany in the 1920s had the most advanced industrial technology in the world. Didn't stop hyperinflation. Britain in the 1960s pioneered computing and nuclear power. Didn't stop imperial decline. Japan in the 1980s had technological superiority in electronics, automotive, robotics. Didn't prevent 30 years of stagnation after their debt bubble burst. Technology creates productivity, but it doesn't eliminate the consequences of creating currency faster than value. The math always wins, always. Objection 2, the dollar is too big to fail. Hits 70% of global foreign exchange reserves. Every major commodity priced in dollars. Central banks worldwide hold trillions in dollar assets. They can't afford to let it collapse. They'll support it. Wrong. That's exactly what they said about the Roman denarius. It was the only currency for known trade. Too integrated to fail. It failed. That's what they said about sterling. The empire covers a quarter of the Earth's surface. Too big to fail? It failed. Size doesn't prevent collapse. Size determines how catastrophic the collapse is when confidence breaks. And confidence is a psychological phenomenon. It shifts suddenly. We just watched it crack in 48 hours. Objection 3, American exceptionalism. We're the United States, strongest military, most dynamic economy, deepest capital markets, best universities, most innovation. We've been the superpower for 80 years. We're not Rome, we're not Weimar, we're not Britain, we're exceptional. Every empire thought they were exceptional. Every single one. Rome thought they were eternal, built monuments to permanence. Britain thought they ruled by divine right. The sun would never set on their empire. They were all certain they had advantages that made them immune to historical patterns. They were all wrong. Exceptionalism is a story we tell ourselves. The math doesn't care about stories. The pattern doesn't bend for narratives. So those are the objections. Destroyed. Now let's talk about what you actually do, how you position for stage 4. Not with panic, not with fear, with clear understanding of historical reality. If we're in stage 3 and stage 4 is inevitable, positioning is everything. Let me break down the framework. These aren't specific investment recommendations. I'm not a financial advisor. This is historical pattern recognition applied to asset allocation strategy. Principle 1. Understand what money actually represents. Money is a claim on future productivity. It's supposed to store value across time, but when the system issuing money creates it faster than the economy produces value, your claim is being diluted. Every dollar in your savings account represents a smaller slice of the productivity pie. This isn't theoretical, it's mathematical. The national debt grows $8 billion per day. The money supply grows faster than GDP. Your purchasing power erodes whether official inflation numbers admit it or not. Principle 2. Differentiate between currency and wealth. Currency is the paper, the numbers in your account. Wealth is the productive assets, the real things. In stage 4 transitions, currency gets destroyed or massively devalued. Assets denominated in currency lose nominal value temporarily. But real assets, assets with intrinsic value independent of currency, often multiply in value relative to the failing money. Understanding this distinction is the difference between devastation and prosperity. Principle 3. Study what preserved wealth in previous transitions. In Rome, land, productive farms, tangible property with inherent value. In Weimar, real estate exploded in nominal terms. Foreign currency, hard assets. In Britain, American stocks, gold, international diversification. The pattern is consistent. Physical assets survive. Productive assets thrive. Assets with value independent of the failing currency transfer wealth from those who didn't see it coming to those who did. Now I'm going to outline asset categories that history shows work in stage 4. Remember, this isn't advice. This is pattern recognition. Historical precedent. What has worked before when reserve currencies collapsed? Hard assets with inherent scarcity. Gold has preserved purchasing power through every currency collapse in recorded history. Not because gold is magical, because it can't be printed. Supply is limited by physics and geology. When confidence in fiat currency breaks, capital flows to assets with verifiable scarcity. Gold hit $5,608 this week for exactly this reason. Flight from currency to hard metal, silver, platinum, real commodities with industrial use and limited supply. These maintain value when paper doesn't. Productive real estate, not speculation, production. Agricultural land that grows food, income-producing properties that generate cash flow. Real assets that create value independent of currency. If the dollar loses 50% of its purchasing power, rent doesn't disappear. Food demand doesn't vanish. Productive real estate denominated in devalued currency often skyrockets in nominal price while preserving real value. In Weimar, real estate owners became wealthy while cash savers were destroyed. Equity in productive businesses. Not overvalued tech stocks, not speculation. Productive companies that make things people need. Energy, food, essential services, infrastructure. If you own a piece of a productive enterprise, currency devaluation might reduce nominal stock price temporarily, but the underlying business keeps producing value. In Weimar, shareholders in productive companies saw wealth multiply, while bondholders and cash savers lost everything. The key is productivity. Real earnings, real value creation, international diversification. Don't keep all wealth in a single currency system. If the dollar is entering stage 4, having assets in multiple currency zones reduces concentration risk, not because other currencies are perfect. Because diversification across imperfect systems beats concentration in a failing one. Norwegian krone, Swiss franc, Singapore dollar, even yuan despite its own problems. Spreading currency exposure reduces the impact of any single currency collapse. Skills and human capital. This one's underrated. In every stage 4 transition, people with valuable skills maintain purchasing power even as currency fails. Doctors, engineers, skilled trades, software developers, people who produce value others need. Your ability to generate income can't be inflated away, can't be debased, can't be confiscated. Human capital is the ultimate inflation hedge. And here's the critical part. This isn't about timing. You can't time stage 4. Nobody can. What you can do is position so that when it happens, whether it's next month or next year or 3 years from now, you're not devastated. You might even benefit. Let me paint 2 scenarios. Same person, same starting wealth, different positioning. Watch what happens. Scenario A, typical American, 60% of net worth in their home, mortgaged, 30% in 401k, mostly US stocks and bonds, 10% in savings account. They believe in the system, trust institutions. Think this is just market volatility. When stage 4 hits, their savings lose 70 to 80% of purchasing power through inflation or devaluation. Their 401k, denominated in devalued dollars, crashes 40 to 60% in real terms. Their home, while nominally valuable, is mortgaged in old currency terms but provides little actual wealth protection. They've just lost decades of accumulated wealth in months, not because they were reckless, because they didn't understand the pattern. Scenario B, same person, same starting point. But they studied history. 40% in hard assets, gold, silver, commodities, real scarcity, 30% in productive real estate and international equities, 20% in productive businesses they control or have equity in, 10% in cash for liquidity across multiple currencies. When stage 4 hits, their hard assets multiply in nominal terms, preserve purchasing power, their real estate maintains real value, their productive businesses keep generating income, their international holdings offset dollar decline. They don't just survive, they potentially multiply wealth while others are devastated. Same person, different understanding, completely different outcome. That's the power of pattern recognition. That's why what happened this week matters. Now let me tell you what happens next. Short term, medium term, long term. So you know what signals to watch. Short term, next few weeks, expect extreme volatility. Markets will swing 5 to 10% daily. Financial media will oscillate between panic and reassurance. Central banks will announce emergency measures. Politicians will promise solutions. None of it will address the structural problem. Because the structural problem is mathematical. 38.43 trillion in debt, growing 8 billion per day. While GDP grows maybe 2 to 3% annually, the math doesn't work, can't work, won't work. Medium term, next 3 to 6 months, watch for 3 specific signals. Signal 1, foreign reserve holders accelerating dollar sales. If China, Japan, and Saudi Arabia start unwinding positions aggressively, that confirms stage 3 acceleration. Signal 2, the Federal Reserve losing control of the yield curve. If long-term rates spike despite intervention, that's loss of confidence. That's the bond market rejecting Fed authority. Signal 3, gold sustaining above $5,000 per ounce. This week, it hit 5,608, then crashed on margin liquidation. If it stabilizes above 5,000 despite intervention, that's permanent capital flight from currency to hard assets. If you see all 3 signals, stage 4 is imminent, not theoretical, immediate. Long-term, 1 to 3 years. Expect a monetary system reset. The exact mechanism doesn't matter. Might be a new digital currency, might be a return to commodity backing, might be a multipolar reserve system with regional currencies. The specific structure is less important than the outcome. The dollar's exclusive reserve status ends, and when it does, wealth transfers from dollar-denominated assets to whatever replaces it. This is the most important financial transition of our lifetime, possibly of the century. The empire that dominated the post-World War II era is reaching the end of its currency cycle. The pattern that destroyed Rome, Weimar, and Britain is here, active, accelerating. And the decisions you make in the next 6 months will determine whether you're devastated by this transition or positioned to benefit from it. Let me end with absolute clarity. The pattern doesn't care about fairness. It doesn't care about who worked hard or saved responsibly or played by the rules. Currency collapses destroy the savings of prudent people and the pensions of honest workers. That's not right. It's not fair. But it's history. It's the documented consequence of every empire that debased its currency and lost reserve status. You have two choices right now. You can hope this time is different. Trust that institutions will fix it. Believe that technology or exceptionalism or unprecedented intervention will break the pattern. 17 empires made that choice. All 17 collapsed. Or you can study the pattern. Understand where we are in the sequence. Position accordingly. Not with fear, not with panic, with clear recognition of historical reality, with knowledge that wealth doesn't disappear in transitions. It moves. And if you understand the pattern, you know where it's moving. What happened this week, January 28th to January 31st, 2026, wasn't the event. It was the signal, the warning, the visible crack in stage 3 that shows us exactly where this is headed. Microsoft's $357 billion loss, gold's historic spike and crash, the Fed's loss of control, foreign institutions questioning U.S. debt, the dollar's fall, China's record treasury sales. These aren't disconnected events, they're symptoms. Manifestations, proof points of a pattern that's played out across millennia. $7 billion didn't just evaporate from markets this week through volatility and liquidation. It transferred, some into hard assets, some into foreign currencies, perceived as more stable, some into the accounts of those who understood what was happening and positioned accordingly. The next transfer will be bigger, much bigger. Because stage 4 resets entire systems. When the dollar loses reserve status or experiences significant devaluation, trillions will transfer, the largest wealth transfer in human history, from those holding old denominator assets to those positioned in the new reality. The only question that matters is which side of that transfer you'll be on. Will you be holding paper promises denominated in a debasing currency? Or will you own real assets with inherent value? Will you trust institutions that have never successfully managed this transition? Or will you trust history, mathematics, and pattern recognition? The pattern is here. The math is clear. The signals are visible. What you do next determines everything. Go back through this, verify every claim. Rome's denarius from 98% silver to 2%. Check it. Weimar's exchange rate from 191 marks per dollar to 4.2 trillion. Verify it. Britain's pound devaluation from 486 to 240. Research it. U.S. national debt at 38.43 trillion. Growing 8 billion per day, interest costs at 1.2 trillion. It's all documented, all verifiable, all real. Then ask yourself one question. If we're in stage 3 and every historical example shows stage 4 is inevitable, are you positioned for what's coming? Because ready or not, whether you believe it or not, the pattern doesn't wait. It doesn't pause. It doesn't reverse. It only accelerates. And if this helped you understand what's actually happening behind the headlines, what the real stakes are, what the pattern means for your financial future, then you need to watch what I'm releasing next. Because the next video breaks down exactly how to build a stage 4 portfolio. Specific asset allocation, specific protection strategies, specific positioning for the wealth transfer that's coming. You're going to want to see that. The transfer is coming. The pattern is unstoppable. Be on the right side of it. Subscribe now. The clock is ticking.